The looming threat of China's massive debt crisis cannot be ignored, as it can potentially impact global markets and individuals. This video explains how it affects us. China is known for its rapid economic growth over the past few decades. However, this rapid growth has come at a cost. China has been racking up debt at an alarming rate, and this debt has become a significant concern for policymakers around the world. The question is, how did China accumulate all this debt? You see, the Chinese government has heavily invested in infrastructure projects to support economic growth. However, many of these projects have been financed through debt, and there are concerns that some may not generate enough returns to repay the debt. Chinese banks are also facing bad loans. Since most commercial banks in China are state-owned, they frequently base their choices on directives from the government rather than on economic practicality. This includes making loans to businesses and sectors owned by, under the control of, or supported by the state.
A massive unleashing of credit growth back then led to unused infrastructure, ghost towns, excess industrial capacity, and an overhang of debt.
Notwithstanding the possibility that the money may not be returned. As a result, as of April 2023, bad loans provided by Chinese banks totaled $317,732.39. Chinese banks also hold $990.22 billion in special mention loans, a category of non-performing loans at risk of default. Local government debt is another cause for concern. China's debt is primarily held by state-owned banks and local governments. As the economy recovers from a 3-year beating from the COVID-19 pandemic, tackling the pile of concealed debt amassed by local governments in China is again at the top of the political agenda. Over the past 8 years, the debt value of these local government financing vehicles has almost quadrupled. According to a Goldman Sachs assessment, the hidden debt might be as much as $8.2 trillion, or over half of China's GDP. Local governments have been issuing an unprecedented number of bonds. Most of the bond revenue is not allocated towards infrastructure investment, but is used to repay maturing debt. You see, local governments heavily depend on selling land to developers to generate a third of their income.
Alright, we owe a bunch of cheap money, but we aren't making the money we need to pay back those cheap loans from our huge uninhabited properties. Tell you what. If you give us slightly more expensive loans, we'll use that money to pay back the cheap loans,
resulting in a bias toward making more loans than necessary. Chinese companies' overseas bond defaults are increasing, amounting to $8.7 billion, and 34% of these are real estate company bonds in 2021. Evergrande, the second largest real estate developer in China, failed to make a short-term debt payment in June 2021. And as a result, the Chinese government seized the company's bank accounts. The Chinese government has also been very active in trying to stimulate the economy through monetary policy. This has led to a surge in lending and credit growth, which has fueled the debt growth, leading to concerns over the sustainability of the country's debt levels. Now, this may not seem like a big deal, but the problem is that China's debt is growing at an alarming rate, and it doesn't look like it will slow down anytime soon. So why should you care about China's debt crisis? One of the primary reasons everyone should be worried about China's debt crisis is that China is one of the largest economies in the world. Its economic growth has been fueling global growth for decades, and any substantial slowdown in the Chinese economy could cause significant upheaval in the world economy. China's status as a significant trading nation further amplifies the risk. Its extensive network of trade relationships, coupled with the interconnectedness of the global economy, means that any disruption in Chinese economic activity could quickly spread to other countries. You see, numerous countries rely heavily on China as an export market and a source of supply chain inputs. A slowdown in Chinese demand could decrease export revenues for these countries. Secondly, it might not provide financial aid to developing countries. Over the years, China has invested heavily in infrastructure projects in developing countries. This aid has played a critical role in fostering bilateral relationships and promoting economic growth. However, with its economy struggling, it might be unable to continue providing financial aid to those countries. This could lead to resentment and potentially worsen China's relationships with other nations. Furthermore, as China attempts to stimulate its economy, it could start dumping cheap products in other countries, lowering prices and causing damage to local economies.
Think about the economic consequences of how we're intertwined. 22% of American manufactured goods imports come from China. So just imagine China became like Russia. In other words, you say, I don't want to take imports. So people don't buy their Nikes, they don't buy their Apples, they don't buy things that are produced in China and so on. Do you know what that would mean economically for us in terms of the inflation rate and the consequences because of how they're intertwined?
This can lead to protests and worsen China's relationships with other nations. Thirdly, China's economic struggles can increase political tension by exacerbating pre-existing issues. Tensions between Hong Kong and China have been rising over the past few years. With China's economy struggling, it might become more forceful in quelling protests in Hong Kong, leading to heightened tensions between the two regions. Internationally, increased debt could create a power imbalance between China and other nations, leading to political tensions. China's relations with Taiwan and the U.S. have also been strained. If the U.S. were to impose sanctions on China in response to its economic struggles, it could further deteriorate relations between these nations. Furthermore, China's economic struggles could cause the country to shift its focus and become more inward-looking. To stimulate its economy, it might prioritize domestic policies, which could reduce investments in international relations. China's involvement in international organizations and conflicts could decrease, creating a leadership vacuum and potentially worsening political tensions globally. The shift in focus could make China more isolationist, which could have global repercussions. Another reason why everyone should be worried about China's debt crisis is because the country is the largest foreign holder of U.S. debt. The debt crisis can lead to a currency devaluation. As of April 2023, China holds $859 billion in U.S. debt. If China were to sell off its U.S. debt holdings to pay off its debt, it could cause a significant drop in the value of the U.S. dollar. This would lead to a rise in interest rates and could severely impact the U.S. economy and, by extension, the global economy. Given China's status as the world's leading trading nation, a devalued currency can lead to ripple effects in developing countries that rely on exports to China for economic growth. All these issues tied to China's debt crisis ultimately led to a global slowdown. You see, a slowdown in the Chinese economy reduces global demand for goods and negatively impacts international trade. This translates to job losses, lower incomes, and increased poverty rates across the globe. But who will suffer the most? People and businesses with significant investments in Chinese firms and equities will suffer the most in industrialized nations like the United States. Global investors exposed to Chinese assets, including stocks, bonds, and currency, may experience losses, potentially leading to a broader risk aversion sentiment in financial markets. Long-term effects could be favorable in some cases. You see, a severe economic slowdown or Chinese economic collapse could hasten the widespread departure of international businesses from China and the rebalancing of global supply networks. As a result, the world's reliance on China would decline, which may boost economies in countries like Vietnam, India, and Indonesia, which are more than glad to host international factories that have left China. The benefits will take time. However, adverse effects will be felt immediately. This situation is not sustainable, creating a ripple effect that will cause tumultuous times for the global economy.
According to our language, we enter into a new era, and also aiming to play a robust role in the international affairs from economic, financial, and environmental front. China needs to tackle her own challenges at home while keeping the expectation of the whole world in mind.
For one, it leads to losing investor confidence in China's economy, which can reduce foreign investment. The lack of foreign investment can decrease export revenues, worsening the economy. In light of all these repercussions, it is clear that China's debt crisis is a problem that should concern everyone. We must address this issue and work together to resolve the crisis. So, Are there any steps that China has taken? The Chinese government has been very active in addressing the debt crisis. China has tried to tackle local government debt, which was a major concern. Xi Jinping, president of China and leader of the country's ruling Communist Party, stressed the importance of preventing and averting local government debt concerns and urged further action against unpaid secret debt. However, many experts believe that the measures taken by the Chinese government may not be enough. There are fears that the Chinese economy may be heading towards a hard landing, which would have severe consequences for the world's economy. However, here are the main steps China could take to prevent further debt increase. 1. China should encourage domestic consumption. Expanding domestic consumption can reduce China's dependence on debt-fueled investments and stimulate economic growth. Policies that promote income redistribution, reduce income inequality, and enhance social welfare can help drive this change. Secondly, China needs to strengthen financial discipline. China's financial discipline must improve to prevent further debt escalation. This includes enhancing risk management systems, streamlining banking practices, and intensifying regulatory oversight to avoid malpractice and unsustainable lending practices. Thirdly, China needs to engage in structural improvements. You see, structural improvements refer to changes made to the fundamental economic, social, and institutional systems of a country to improve its overall efficiency, productivity, and resilience. These reforms typically involve modifying policies, regulations, and institutions to enhance market competition, promote innovation, and foster sustainable growth. When China engages in structural reforms, it could restrain debt accumulation while stimulating a resilient economy.
But when a higher economic growth will be replaced by the high-quality development. At the same time, in the 19th Party Congress, there's a very interesting sentence saying that China offered the whole world a new option for those countries who would like to have a better and quick development while maintaining its independence.
So what can you do about this? Well, there are a few things that you can do to protect yourself from the potential fallout of China's debt crisis. Firstly, you can diversify your investments and spread your money across different asset classes in your portfolio. This way, you won't be as heavily impacted if one country's economy crashes. Each asset class, stocks, bonds, real estate, and commodities, has different risk and return characteristics, and they tend to perform differently under various market conditions. Similarly, you can also diversify within each class, investing in other sectors and industries. For example, you could invest in technology, healthcare, finance, and energy sectors within the stock market. This approach prevents concentration risk by not relying heavily on one sector or industry. Diversification doesn't end with the initial allocation of your investments. Your portfolio requires regular monitoring and rebalancing. Over time, the performance of your investments may lead to an imbalance in your portfolio's allocation. To maintain diversification, you must review your investments periodically and make necessary adjustments to restore the desired asset allocation. Secondly, you can subscribe to my channel and stay informed about what's happening in the global economy. This will allow you to make informed decisions about your investments and other financial decisions. Additionally, you can also consider investing in emerging markets. China's Belt and Road Initiative is a game changer for many emerging markets. This means there is hope in China. The plan to encourage economic collaboration between China and other countries has created investment opportunities in countries that would otherwise be overlooked. By identifying such potential regions, we can reap the rewards of China's growth while mitigating potential financial risks. Lastly, good financial habits can go a long way in protecting ourselves. Cutting unnecessary expenses, making wise investment decisions, reducing debts, and having an emergency fund can save us from financial shocks. By taking control of our finances, we can mitigate the risks associated with a crisis like China's debt and ensure our economic security. China's debt crisis is not just a Chinese problem. It is a global problem that requires urgent attention. The world must solve this crisis before it is too late. We need to push for greater transparency and accountability in China's financial system and develop a plan for dealing with the fallout if a crisis occurs. If we fail to address this crisis now, it will only worsen, and the consequences will be severe for everyone. China's debt crisis is something that everyone should be worried about. However, by diversifying your investments, staying informed, and advocating for action, you can protect yourself from the potential fallout of this crisis. Click on the following video to explore the next chapter of understanding our economy.